Hey, this is Jim Damschroeder, Portfolio Think Tank, and today we're going to walk through Robinhood investing, when you should use it and when you shouldn't use it. Let's check it out. Alright, I'm here at the Robinhood app, or Robinhood website rather. Most of the users know it from their app, and they've got an easy to use app, and they specialize in helping investors get into investing for the first time. And at that, they're probably the best in the world at it, because they've done a really good job of making things easy. But easy isn't always best, and when you have a little bit more money, you might be surprised to learn how much trading for free is actually costing you. So let's delve in. We'll learn how Robinhood makes their money, and we'll figure out if you should still be trading at Robinhood. Okay, I've made a spreadsheet here with some numbers in Robinhood. We'll walk kind of through the whole shooting match together. But ultimately, what Robinhood does is they sell their orders to market makers. And it's funny, there's an article on it just today called Robinhood. This is at CNBC.com. Robinhood tanks after SEC chair tells Barron's that banning payment for order flow is a possibility. Kind of a big move on the SEC's part, and in my opinion, it's a good move. The problem with paying for order flow is it's all very opaque. Investors get no transparency. They get kind of secretly raked over the coals, and the SEC has actually done a pretty good job of acting in investors' best interests. So this could really happen. Don't worry about Robinhood. They'll figure out some other way to make money. Let's focus about you and your account and your money and whether you should be there. So paying for order flow is the practice where money, where a market maker, that's someone who basically earns their living on the in-betweens, on the what's called the bid-ask spread. I'm willing to buy a stock for $1. I'm willing to sell that stock for $1.02. That's a 2-cent spread, or a 2-penny spread, or in this case also a 2% spread. So over the last 2 decades or 3 decades, spreads used to be huge and everyone on Wall Street made money. Now spreads are tiny because we don't trade in called teenies, which is an eighth of a dollar. We trade in pennies. And that's compressed spreads together with electronic trading. And money, I want to call them money managers, but they're not money managers, they're market makers. Those market makers now figured out that they can pay people for order flow, which is really kind of a slimy thing to do, because there's another law out there called best execution. Companies are legally obligated to provide a best execution. So under a best execution, theoretically, it wouldn't make sense for a market maker to pay for order flow because they would just be giving the best execution. But in reality, there's different types of best execution. It's not just best price. It could be the fastest, and they could change their mind about what best execution means in any given order at any given time. They don't consult you, they don't tell you, you don't even know what's happening. And that's paying for order flow is kind of this dirty little thing right now going on, and Robinhood is at the front of it. Another couple companies are very involved in this, and let's check that out too. Here is a company that just went public through a SPAC, or at least tried to, called Apex Clearing. I was pretty familiar with them because I thought about using them for Portfolio Think Tank, and I just couldn't really get past the fact that all they do is sell order flow, which I believe means that all of the companies that work with Apex are companies that are ultimately selling their order flow, and I'm going to out them here. So I know some of these companies that I'm sure there's ways of working with them that don't sell their order flow. but I would be very cautious and very nervous about working with any company that's selling your order flow. And this, by the way, now includes Charles Schwab, and a lot of the big boys are doing it because it's hard to compete against free commissions. People see free and they go to it like a moth to the light. And let me show you the bug zapper. All right, here's the economics of Robinhood. I calculated this two different ways. Bottom line number, here's 2.79%, here's another one at 2.4%. That's how much they make off of your account every year off of a free account. Now everyone's going to be different. The more you trade, the worse it's going to be. The less you trade, the better it's going to be. But basically how we get there is, this is the number of custody assets that they have. That's 81 billion. And this is the number which represents 4 times their last quarter prior to IPO's revenue. So 4 times the most recent revenue divided by their assets under management basically gives their per account percentage fee. This methodology got 2.79%. Another methodology, just taking through the numbers obtained in a slightly different spot by your average account size. Their average account size is only $4,500, and that divided by the custody assets came out at 2.4%. So somewhere in there, we won't focus too much on that exact number, but look at these numbers. So imagine that this is the account size that you have with them. If you have 5,000 bucks, your free trading costs you, on average, 121 bucks a year. And you know what? I think you should be fine with that. They're helping you get started as an investor, and I say good luck, more power to you. But man, you don't even have to have a whole lot of money. All the money you have is always a lot of money, but say you had 25 grand, you're paying them now $605, to be able to trade with them. That, I think that might be too much. Obviously, the more money you have, the bigger that percentage, the more active it is, the higher the percent. But these fees here, $50,000, you're paying Robinhood likely over $1,000 a year. I want to contrast that. This is what we charge. We charge 75 basis points, and these are the corresponding fees that Portfolio Think Tank collects from our investors. And we do this providing optimization, backtesting, portfolio analytics, and automation services. So really nothing to do with the trading. We don't make any money on commissions. We try to help your money grow, and we have a lot of tools that we've built to help do that and treat it more like a portfolio, which, especially if you're having a tough time trading, I would consider taking a portfolio level approach is probably the single best thing you can do for yourself. So with all this, when should you graduate from Robinhood? I gotta say, I think it's probably more than $10,000, but geez, if you've got an account bigger than $50,000 and you're still at Robinhood, I think you're making I think you're making a real error. And whether you're with us or with tons of companies out there that would love to earn your business, I think you'll be able to find a lot better ways of managing your money than doing it at 2.5%. Most money managers work for a little under 1%. Most ETFs now are closer to 0.5%. And of course, mutual funds are around 1%. I've got some some things which show why we think you should probably just invest in the underlying stocks, which are of course then free, plus you get better diversification. So if you fall into this bucket and you're with Robinhood, or if you are with one of these companies that is probably selling their orders, because I don't think Apex works any other way. And by the way, Apex's IPO was supposed to be completed in the second quarter, and tomorrow is September and it's still not done. So I think the SEC is serious about holding up this stuff, and is seriously concerned about selling order flow. It's a little bit dirty, and I don't think the SEC, I don't think Joe Biden's SEC really wants to go this way. So, and if you have money in these companies, it's not like you're going to lose it if they change the rules. They're just going to be kind of a scramble while they try to figure out something better to do. So we recommend working with a fiduciary. A fiduciary is someone that puts their clients first. And we have a website here which sort of does a compare and contrast. We are a fiduciary, which means we're legally obliged to put your interests in front of ours. And this is the big difference between most advisors and most brokers. So brokers and commission people and people that are selling order flow, just assume that they're not a fiduciary. If they say they are, they might have some other conflicts, which would be wise to be explored. But take a look at kind of the differences in what you get, and make a decision for yourself. Doing the math, where you think you should be. All right. Well, we're here to help make investors make better decisions and help investors systematize and optimize portfolio strategies to get your emotions out of the game and use some of the best science to create the best portfolios. So I hope this helps. If you like it, please hit the button. It really helps me with the YouTube subscribers and their algorithm. And if there's somebody that you think could benefit from this, please share it with them. All right. Good luck. Happy trading. Happy investing. Thanks.